So what do these developments say about the health of the U.S. economic recovery? For that, we turn to Neil Irwin, who covers business and economics for The Washington Post. Neil, it's good to have you back with us.
Thank you.
So looking at all these numbers and all these indicators, what do you pay the most attention to this week?
Well, what we saw is a third quarter growth number. The U.S. economy is not falling off a cliff. The U.S. economy is plugging along. We grew at a 2.5% rate in the July through September quarter. That's not great, but it is enough to mean that we're not contracting. We're not falling back into the abyss and back into a new recession.
So does that mean that there will not be a double dip?
Look, it could always happen, but if it did happen, it didn't start in the third quarter, it would appear. What we're seeing is that even as the job market's very rough, we're not seeing robust growth by any measure. But what we are seeing is a certain resilience in the U.S. economy in the sense that businesses keep investing, consumers keep spending money, they're paying down debts. So it's very slow, it's very painful, it's very sluggish, but it is growth, and that's something.
What are businesses investing in? Do we know?
Equipment and software spending has been rising a lot for 2 years running now. It rose at a 17% annual rate in the third quarter. Businesses back in 2009, they weren't buying new equipment. They weren't investing in new factories. There's a catch-up effect going on where they're saying, you know what, we need to buy some new equipment just to make up for what's worn out. And so that's creating, a real driver for the economy. That's been one of the sources of strength in this recovery.
But one keeps hearing that businesses there's still this air of uncertainty hanging over everything, and the businesses are holding back. So how do you square that with what some of these numbers show?
Yeah, what's happening is businesses, they're buying enough equipment and they're hiring enough employees to keep up with demand they already see. What they're not doing is investing in the future. They're not expanding their capacity. They're not building a new factory and hiring 1,000 new workers to staff it. Instead, they're only doing what they absolutely have to fulfill the demand they're seeing from their consumers. So as long as that's the case, we won't see rapid growth. We'll see this kind of 2 to 3% growth that's really treading water rather than growing rapidly.
And what about consumers? What are they buying?
What they're not buying is a lot of big-ticket items. So auto sales, we saw with Whirlpool, appliance sales, these big-ticket durable goods haven't really risen the way you would hope them to. That said, people have cut back so much that there's not the room to cut that you might expect.
And is it possible to say which one of these, or is it both, that is the main driver for growth? Is it mostly the investment? Is it the consumers, or what?
Look, consumers are weighed down by a lot of things. They have huge household debts, mortgages that they're paying off. People are underwater on their mortgages, and that's what's holding back consumers. Consumer spending is rising fairly slowly. The corporate sector is actually in good financial shape. They have lots of money on their balance sheets. They have access to the debt markets. They can borrow money when they need to. Debt levels are fairly modest. So this growth out of the corporate sector, that's one of our best hopes going forward for this expansion to continue.
But how healthy, Neil Irwin, can this recovery be if businesses are still not hiring people in a big way?
Well, ultimately, it will never feel like a recovery until that changes. And what we saw this week is companies are expanding, but only as much as they absolutely have to. They're still reluctant to bring on employees. We saw very weak job growth the last few months. Unless that changes, this will not feel like a recovery to a lot of Americans. This will not feel like a place where we have a low unemployment rate and the conditions we all want to see.
And what about the role of Europe in all this? They did come up with a deal, although there have been deals before that seemed to fall apart, or at least not be as significant as they looked initially. What role is that playing in this?
It's amazing the linkages we've seen between the U.S. economy and Europe over the last couple of years. It seems like every time things flare up over there and there's another wave of crisis and panic, the next couple of months you see weaker job growth here and you see growth slow down over here. Businesses are connected to it. It affects the stock market. It has a lot of linkages that are greater than you might expect. And so finding a long-term solution for Europe's problems is really important for the U.S. economy. What we saw this week was progress, but not an absolute solution. There's a lot that has to be fixed there still.
So as you look ahead, what are the most important things you're paying attention to?
It's one big thing is whether the Europeans can take this framework for an agreement and a deal and turn it into actually something that's executed that really does stand as a big fund that's kind of a wall of money preventing a debt crisis from causing a collapse in European nations. That's a key.
And the Federal Reserve here, to what extent is that a factor in all this?
Well, they're meeting next week and going to decide what to do next. They've done a lot. They've had interest rates near zero for almost 3 years now. They announced a couple of things at their last two meetings to try and push longer-term interest rates down lower. They'll talk about more things in that vein this week. Probably won't do it next week, rather. Probably won't pull the trigger, but they're certainly looking for more ways that they can try and push money into the economy and get growth a little faster.
Well, there's a lot to chew on, and there'll be even more in the days to come. Neil Irwin of the Washington Post, thank you.
Thanks, Judy.